Welcome to the Allan Small Financial Show. Thank you for taking time out of your busy day to spend it with us. We have a great show today. We're going to touch on a lot of really timely topics. There's a lot of nervousness out there in the marketplace. Q1 for 2023 is now in the books. And I think for the most part, individual investors have been quite nervous about what's going on in the world, the economy, the markets, etc. So we're going to talk a bit about that. But as you can see here, we have a lot of topics to get through today. So we're going to talk about, as I said, gloomy investors, why they might be surprised to learn that the market performance isn't really following a gloomy path. Market performance has actually been quite good over the first 3 months of this year. We're going to also go through our This Week segment, where I talk about what I believe is important for individual investors to consider before you make your investment decisions. And I usually touch on 3 topics. I have 3 great ones for you today. OPEC Plus cuts oil production. Who is OPEC Plus? Well, OPEC nations, Saudi Arabia, Iran, Iraq, these would be OPEC nations. The plus part comes in when you add in Russia. They made a surprise, kind of a unprecedented or unexpected cut in production of oil. How does that affecting the markets, or how could that affect the markets going forward? Banks. Are they too big to fail? Another topic of conversation that we just had over the past month with the recent bank failures in the US and Europe. Are banks too big to fail? And is that a bad thing or a good thing? Short selling. Who is shorting this market? What is short selling? What does it mean for individual investors? We'll discuss. Key dates to watch going forward. Now, this is also really important, kind of goes along with the This Week component. Key dates are very important to know and have in your calendar because they're definitely days of the month that we're going to get economic data, and this data will definitely move markets up or down. First time or first home savings account has been launched by the federal government, started on April 1st, and this is a new account that the government created to try and help Canadians save for their first homes. So the first home savings account is now active in most financial institutions. We'll talk a bit about that, how they work and the rules around them. And lastly, we'll take your questions that you have regarding the markets, your portfolios. I usually get through a few here. What I don't get through today, hopefully I'll be able to answer throughout the week or on next show. But if you have any questions, don't hesitate to put them in the chat box, whether you're watching through YouTube or Facebook or wherever else online. Love to read those questions and answer them for you. So let's get on with the show. So gloomy investors, I've heard a lot from them over the past 3 months, the first quarter of this year. I've had many, unfortunately, negative questions. Some of them very big in nature, such as, if we had a nuclear war between Russia and the US, what would happen to my portfolio? Well, I quickly answered, I don't think it would matter a whole lot what your portfolio was worth if there was a nuclear war. I think we would have bigger problems on the horizon. But definitely something that makes people nervous. What happens if the US currency were to crash, or the US currency was no longer the currency of choice for the world, that perhaps there would be another currency that would dominate or be used more by other countries outside of North America? What would happen to US investments, US dollar? What would happen to US government bonds, treasuries? So a great question, and one that people are nervous about again. I know a lot of people ask me about bank failures and what happened in the US with 2 big bank failures, 2 of the largest bank failures that we've seen really ever, and made people very, very nervous. People are still hearing about recessions. And even one person asked me about the possibility of a depression, that they read online somewhere that there would be possibly a depression coming down the road. All this information is out there on the internet right now. And I can say, honestly, in my 25-year career, I think today I've probably heard more, I would say in the last few months, more negativity in the last few months than I've heard in all my years of managing money in all my 25 years of being in this industry. And that says something because we went through a much bigger crisis in 2008. The bank crisis we just went through, I guess, or the US went through, was nothing compared to what the world went through in 2008. So we've definitely seen more difficult times. So why such negativity? Is it warranted? Well, I don't think so. I think the fact that there's so much information through social media, online, for viewers or investors to watch and see, I think they're very easily swayed today by a lot of this negativity. You may not feel as though you're being more negative than usual, but this negativity is getting to be more negative today. Well, I'm going to show you the answer is no. We have a few charts here, which I'll show. First one, the S&P 500. The S&P 500 is the largest market or index in North America. And you can see this is a 3-month chart. The chart clearly goes from the bottom left to the top right. And you will see that for the first 3 months, with all this negativity, the major index in North America was up 7%. So definitely a good thing, right? You extrapolate that over the rest of the year, that's a 28% return for the year, a number that we would love to see for 2023. We go to a next chart here, the NASDAQ, which is another large index in the US. This one has a lot of tech stocks on the index, included in the index. And tech stocks, as we all know, was the hardest hit sector last year. Well, this year, it's been the darling for 2023 so far. Again, look at the chart, bottom left to the top right. So that tells us that tech stocks predominantly have outperformed. And the NASDAQ was up 16% for the first 3 months of 2023. So as you can see, no negative numbers. And lastly, excuse me, we have a chart of the TSX, Toronto Stock Exchange, which I will show you. And once again, you can see bottom left to the top right. And you can clearly see over the past few months how much the market has gone higher. And the TSX up 3.5% for the first quarter of this year. So take that out for the full year, you're looking at a 14-15% return for the full year. So even with all this negativity out there in the world today, in my opinion, it's not warranted. All the fears, I understand them. When you read things about currency or about possible recessions or that the economy is slowing down in general, I understand that people will be nervous. A lot of people have all their money in their RSPs, in their tax-free savings accounts, Canadian investment accounts, or perhaps have their children's tuition in an RESP, that money that they're going to need for their kids' university or college. So you're going to be nervous, of course, when you see and read about all this negativity online. But make no mistake about it. I just think these are fear mongers. These are individuals or companies that put out these really negative commentary for people to gravitate towards. How often do you gravitate to something good? Most of the time, we tend to gravitate to something, unfortunately, that's not good or bad. And so they want eyeballs. So what do? They put out provocative statements that they're going to lure people by having them out there. So overall, my comment is it's never as bad as what you read. At times, it's never as good as what you read either. It's always somewhere in the middle. But numbers don't lie. For the first quarter of 2023, things have been really, really good. And I look forward to this continuation of good markets for the rest of the year. So this is the part of the show where I discuss what I believe is important for individual investors to consider over the next few weeks before you make your investment decisions. And you'll notice there that the first two topics have been on my list for quite some time. In and out, not every week or every show, I should say, but in and out. The first one, Fed Speak, that is always on the list. Every time you have a Federal Reserve governor, this morning we had Loretta Mester talk about how interest rates need to get above 5% once again. And therefore, that tells all of us that she believes interest rates got to go up again in the US. So whenever a Fed official speaks about higher rates, it affects the market. If they were to say we're going to pause, that would probably affect the market in a positive way. So Fed speak's always important. Bond yields. We've talked about bond yields in the past. I really believe interest rates, bond yields tell the whole story as to where the market has been and where it's going. And lastly, dividends and trends. This is something new. If you feel the market is going to have a slower year, or the economy is going to continue to slow and struggle throughout 2023, look to dividend pairs. Look to things that are trending in the economy today for your investment ideas. And we'll go over that as well. So let's get to the first one, Fed speak. Now, as I said, as early as or as recent as this morning, the Federal Reserve was speaking about how not one of the Fed officials, I should say, Loretta Mester, was speaking about how interest rates need to go up even further. And that actually kind of surprises me a little bit. I think with the most recent bank crisis, in my opinion, caused by aggressive higher rates or aggressive interest rate hiking cycle. And we have a chart to show exactly how quickly interest rates have gone up in the US. And you can see here, they've gone up 9 times in the last 12 months. The first rate increase was about 25 basis points, and then 50, and then 475 basis points hikes in a row. And then here we are at the tail end of the hiking cycle, hopefully, and we're still getting these 25 basis point hikes. So it surprises me that when a Fed official says we still have to raise rates even more to tame inflation, I'm surprised, because with the banking crisis, many people have said that that would be equivalent to a 50 basis point hike on its own. The fact that banks are now more cautious, they're not lending as much anymore. Credit is drying up out there for businesses to get a hold of, for individuals to get a hold of, to grow, to acquire, to buy goods. Demand is going to slow down. So you don't necessarily need to be raising rates to slow the demand. The banking crisis and the banks are going to do it for the Fed. And that's been the talk a lot recently. And so to hear that Fed officials are still touting and saying rates need to go higher to fight inflation, I'm quite surprised. If you look at all or many of the inflationary indicators, things that are indicating inflation, or if it's going up or down, you're seeing inflation going down in many areas. Retail spending, you're seeing even jobs growth is starting to slow from the big number we saw at the beginning of the year. You're seeing spending, income, everything that you would want to see if you're the Fed slowing down. Job openings, JOLTS as we call it. We just got that number recently. Job openings actually dropped over 1 million since the previous month. So we had over 10 million jobs available in the US. Now they have about 9 million jobs available in the US, down 1 million from the month prior. And that's a good thing for the Fed, because that means that the labor market is hopefully loosening up a little bit. So overall, very surprised to hear the Fed and the Fed governors talk like that, continue to speak about rising interest rates. But again, keep the Fed close by, understand what they're saying, because that's going to affect how you make your next or the next investment decision. Topic number 2, bond yields. Now, as I always say, interest rates, bond yields tell the whole story. So when everybody was talking about interest rates rising, bond yields have to go up even further. We saw the 2-year government bond rate in the US over 5%. Today, and we have a chart on this, the 2-year rate is below 4%, 3.85 to be exact. And we have a chart of the US 2-year Treasury rate. And you will see that it is well off its previous high. You can see on the far right of this chart how much the 2-year rate has come down. If we go to the next chart that we have, the 10-year government bond rate in the US, that was well over 4% at its peak. Today, it's sitting somewhere around 3.35%. And there it is there. So you can see how much bond yields have come down. And you would think that that's a good thing for the market. And it has been up until recently. Now the bond yields seem to be coming down because the market is telling us that, we may see really a much larger slowdown in the economy than was anticipated. And that's why these yields are falling. Back when the economy was doing quite well, things were growing, and if we saw bond yields not rise as quickly, that was a good thing. Now we're seeing bond yields coming down for negative reasons. So what I tell individual investors how you should look at bond yields is not too high, not too low, kind of just right. Goldilocks, as I like to say, the Goldilocks scenario. So we don't want to see necessarily bond yields fall anymore. That's a negative for markets because it puts fear into investors, because that tells us maybe a recession is coming down the pipeline. But we don't want to see interest rates too high, because then that will compete against the stock market. And we know that things such as tech stocks or other investments don't do well, especially in the most recent rising interest rate environment. So we want to see bond yields kind of level off and stay consistent. Don't gyrate as much as they have. And as you saw in those charts, interest rates have been moving almost as much as the stock market has. And that's not something we want to see. So keep an eye on bond yields. The last topic that I think individual investors need to focus on before you make your investment decisions is this idea of what do we do and how can we make money if the economy is slowing down? And I put on that list, if you recall, look to dividend payers. That's number one. If you can't make money, if the stocks are not going higher, if you're noticing that at best you're just kind of going sideways and treading water, what should you own? Well, I have a few really good dividend paying stocks. First one, Enbridge. All of us pay our Enbridge bill here in Ontario, Toronto, and as long as we're paying that Enbridge bill every month, Enbridge has money coming in. Enbridge is a fantastic company. Stock usually ranges between $50 and $60. Seems to be their range right now in the low 50s, but it's paying almost a 7% dividend. So for all you investors out there that want to make or need to make an income, Enbridge is a fantastic name. They continue to raise that dividend over time. Right now, as I said, paying just under 7%, but it's a name I think you can count on for future dividend increases, or at the very least, maintain the dividend that it pays. Another chart I have of another company called Pioneer Natural Resources. I wanted to give you a variation of companies that are out there. Now, Pioneer actually pays a dividend of almost 13%. It is a U.S. oil and gas investment. And as you can see, stock has gone up recently from its lows. It was as low as below 200 at one point recently, now back above $200 a share. But a lot of investors are buying this for the dividend. So if you're not going to grow or see an appreciation of share value, making a 12, 13% dividend is pretty darn good while you wait for future growth. Next chart I have as another good dividend player, something closer to home. Again, Bank of Nova Scotia. I've talked about Bank of Nova Scotia on this show many times, and Bank of Nova Scotia is paying about a 6.25% dividend. Bank of Nova Scotia trades at around $67 a share, down from the mid-90s. So this is one of those investments that I think you can get great dividends and also capital appreciation. So I think the stock is going to rise at some point in the near future once we get through a lot of the crises that we're going through right now in the banking sector, even though it's U.S. banking sector that has the crisis, but a lot of this is spilling over into Canadian banks as well. Once we get past this, I think a name like Bank of Nova Scotia will definitely move higher. So those are dividend ideas that you could use if you're about to invest in the market. The second thing I had on my list is trends. How you make money in a market that's going sideways. Well, as we know, not everything goes sideways with the market. Things will move higher in a sideways moving market, and those things are usually the trendier investments. What is trending now? Well, one thing that comes to mind is artificial intelligence. So stocks that have anything to do with AI have been moving higher. Microsoft, some of the chip makers, some of the companies that make the chips for artificial intelligence, like NVIDIA, AMD, even Amazon has moved back above $100 a share again. Google, or Alphabet, I should say, back above 100, and Meta, or formerly known Facebook, has been moving significantly higher. They've been talking a lot about artificial intelligence and moving away a little bit from the metaverse and focusing more on AI. So what investments should you be focusing on or considering before you decide what to do with your money over the next few weeks? Look to dividend pairs and look for what companies are in those hot areas that the market is favoring right now. And I think that's what you should be doing before you make your investment decisions. So recently, OPEC or OPEC plus, we say plus because when we add in Russia, it's the OPEC nations plus Russia, had a production cut. Well over 1 million barrels a day was or is going to be cut or reduced in terms of oil production for the world. And what this did really is cause the price of oil to spike. Oil was sitting somewhere in the $60 to $65 range, WTI pricing. And that caused that announcement of a production cut caused the price of oil to spike. And now oil is actually in the low 80s. So it had a significant impact. And there are many analysts out there that talked about how this may or may not affect things going forward with the slowdown, the economic slowdown right across the globe. Price of oil was feeling the effects and dropping in price. And I think Saudi Arabia, who heads up the OPEC nations, wanted to take a proactive view, wanted to be proactive, so they cut production. The main question, I think, for investors and for Bank of Canada and the Federal Reserve, actually, will this cause inflation to move higher again? I've said this on the show a few times now that I believe a lot of what the Fed has done, the Bank of Canada has done with raising interest rates, didn't have as much of an impact on inflation as lower oil prices. When the price at the pumps is much lower, when the cost of filling up your tank with gas is much lower, when businesses can ship goods to and from their customers at a lower cost because energy or oil is cheaper, when we can travel and buy plane tickets cheaper because the cost of filling up an airplane to be able to travel with oil, gasoline is cheaper. It affects us all. It affects all of our wallets. When oil prices rise, it can act as another tax on businesses and investors. So will this affect the inflation rate? Well, I guess time will tell, but I think it can. And if we do see oil stay or elevate to maybe $90 to $100 a barrel, or even go over $100 a barrel, and if it stays at those price points for a while, for a long period of time, I think you will see inflation gradually move higher again. Will that mean that the Fed and Bank of Canada have to continue to raise interest rates? I guess we'll have to see, because raising interest rates to slow demand will be a very harsh and blunt instrument to fight inflation that is being caused mainly because of higher oil prices. So we'll have to see what the Fed says, what the Bank of Canada says, if oil prices were to continue to move higher and stay higher for a longer period of time. But definitely something that individual investors need to focus on. And before we go on to the next topic, I think we have a chart of oil here that we could show. There it is. You can see how much oil has come down. Oil has moved from the top left to the bottom right, which is a good thing, versus bottom left to the top right. And you can see here in this chart how oil prices have spiked in the last little while. So keep an eye on oil prices, because I think it can and will affect inflation. So are banks too big to fail? I guess the quick answer is yes. By the government actions that we've seen in the US and that we would see here in Canada if I think we had a banking crisis here, I think the simple answer is yes. Do I agree with this? Absolutely. I think banks are too big to fail. Now, I'm not here to say that investors in banks, owning shares of banks, owning bank debt, bonds of banks, these people should be, or these investors should be protected. I don't think they should. I don't think investors that are investing in bank stocks should be protected any more than investors investing in any publicly traded company are protected. But I think the deposits of individuals should be protected. It's not that small business's fault that a bank fails, and that now if they had more than, in Canada, 100,000 in their bank account, they would lose everything after 100,000. Or in the US, it's in each bank account is insured up to 250,000. I think that all deposits should be insured. This is our hard-earned money. This is money that we earned working at our place of business or in our small businesses, or that we earned regardless of where we earned it. This is our money. This is not investing in something or buying debt and then taking on some risk. Bank deposits should be insured. That's my opinion. It's interesting, you hear a lot of the US commentary saying banks are too big, banks are too big. And yet at the same time, they say how great the Canadian banking system is. Well, I laugh because in Canada, we're dominated by pretty much 5 or 6 banks. In the US, they have so many more banks down there. We have under 100 banks in Canada. In the US, they have over 4,000 banks. You go to a smaller town in the US, you find a small regional or community bank. In Canada, you go to a small city here, Northern Ontario or wherever, and what do you see? You still see TD, or you still see Royal Bank. So it's interesting when they talk about too big to fail and they say how good our banking system is, we're in the same boat. And possibly even that saying too big to fail even applies more here in Canada. But during the banking crisis, what we saw, and next chart that we have will show it, is a deposit shift between smaller banks and larger banks. You can see on the left side, during the crisis, small banks lost a lot of money. And where did it go? As you can see on the right side of this illustration, they went to the large banks. And so big banks gained a lot more. And that's why you saw a lot of the smaller banks' stocks fall. They also fell for another reason, which we'll get to in the next segment. But when individual investors heard that there was a run on, especially the smaller banks, that many people were taking deposits out and moving them into larger banks, it just snowballed and got worse and worse and worse. And you saw what happened with Silicon Valley Bank, or you saw what happened with Signature Bank in New York. These banks lost deposits, and deposits went to larger banks. And I have some of those larger banks here, some charts on Bank of America. And it's interesting because even though a name like Bank of America gained deposits during this time, their stock prices fell dramatically. Maybe not as much as a smaller regional bank, but they fell dramatically. Here's Bank of America chart. We have a chart of JP Morgan, the largest bank in the US, largest bank in North America, one of the largest banks in the world. Look at their chart. And you can see how much their stock price has fallen. And then you think to yourself, well, that's the US. I live in Canada. Not so fast. We have a chart on TD Bank stock. Look how far TD Bank stock has fallen. Yes, you can see here, nicely regained some of its share value, but still well off its previous highs. So even a TD Bank lost a lot of its value. So the crisis in the banking system, yes, was more to do with smaller regional banks. But understand that when you own an ETF, a basket of bank stocks, and when there's a crisis, people just sell the overall ETF or the basket. And TD Bank might be in that basket, CIBC might be in that basket, Bank of America might be in that basket. And unfortunately, these bigger banks get pulled down with the regional banks, and everyone is left wondering, what is the next shoe to drop? Where is the next crisis going to come? Will it spill over to the larger banks? And that's why you saw a lot of these banks fall in value. But in my opinion, these banks are too big to fail. And we saw this clearly over the past month of March. And I think in our country, banks will always be too big to fail, and deposits should be guaranteed indefinite, because I think this is hard-earned money from all of us that we earn at our place of work. Short selling. What is short selling? Well, it's a way to invest and make money, but it's different. We all know the traditional way. You buy an investment, it goes up in value, you sell it, you make a profit. Well, short selling is actually the opposite. You want the investment to actually fall. So how does this work? Well, very simply, it's an investment idea. You go out and you borrow shares. Let's say shares, again, TD Bank seems to be the hot stock of the show today. So let's use TD. You go out and borrow shares of TD Bank. Then right after you borrow those shares, you sell them on the open market. Now you're left with, let's say, an amount of money. At some point, you need to buy back those shares to give those shares back to the institution or the person that you borrowed them from. So at some point, you got to buy back those shares. Now, if TD Bank is at $100 a share, you sell it for $100 per share, and you buy it back at $80 per share, well, there's your profit. You sold at a high, you bought back in at a low, you pay back the shares to the institution you borrowed them from. So it's a way of basically borrowing shares or selling the market short. So it's basically a way of making money if the market goes down. One of the biggest differences between selling short a stock or selling short or going long, which is the traditional way, buying stock and hoping it goes up, is when you sell short, your loss is unlimited, right? If TD Bank stock you buy at 100, we said it goes down to 80, you buy it back, you make money. But what happens if TD Bank goes to 150? 200, 250, 300. It's unlimited. There is no ceiling. So at some point, you have to buy back the shares you borrowed, and therefore the loss could be unlimited. At some point, you'll just have to buy back those shares and take your lumps and move on. So that's how short selling works. And during the banking crisis, there were billions of dollars made by short sellers. People betting against, especially the regional banks in the US. We saw some of these charts, or we will see some of these charts shortly. We saw people betting on some of the bigger banks. And here we have a chart, which we'll show you in a second. Largest short bets in financial stocks globally. And look who's on the top of the list. TD Bank. This has been a topic of conversation all day today. TD Bank being the most shorted bank. Now we look at banks in Canada as being our pillar of strength. People look at our banks as being strong, well capitalized, and well managed. And yet TD's on this list, Scotiabank is on this list. So what's going on here? Well, short sellers are betting on the next crisis or trying to bring down some of these shares. And when you sell short, keep in mind, you're selling the shares you borrowed. So if you have enough people shorting a stock, you're going to get a lot of investors selling short or selling off some of these stocks. And you can see, as you saw on that chart, Bank of America, JP Morgan was there, Citigroup. So you're seeing a lot of these larger banks coming down in price because people are borrowing stock and these short sellers are just selling the stock. But I also have some charts on some of these smaller banks in the US. First Republic Bank, a name that's been in the news quite a bit. You can see the sell-off there. I'm sure that's due to fear, short selling. Next chart we have is one of PNC Financial, one of my favorite investments to own. PNC Financial is the largest regional bank in the United States, one of the largest banks, top 10 in terms of size. Yet this stock has gone down significantly. At one point, well over $200 a share, and now sitting at $120, $121.75. Another one here, Zions Corporation, another community or regional bank. You can see the fall off there. So overall, a lot of these banks have been sold short. A lot of these banks have been sold due to fear. And in my opinion, these sell-offs are not warranted. And I think you're going to see money creep back into these banks over time. We're already starting to see that here over the last week or so. And I think that will continue as we move on in 2023. So I wanted to go over some key dates to watch for this month, in the month of April. Some dates where I think you could circle on your calendar if you're an investor, and I'm looking at them here. We saw the first one was yesterday, actually, this past Tuesday. We see the JOLTS number. JOLTS are basically job openings and labor turnover. That's what we have. Yesterday, it's a number that the Federal Reserve looks at. And as I said, the number of job openings has decreased. When the job openings keeps going higher, people tend to move around more, seek higher wages, demand more things, which is good, don't get me wrong, for the worker. But unfortunately, for inflation, the Fed looks at this as a negative. So JOLTS was the first. We're going to get jobs numbers. Interesting, this Friday is Good Friday. So the US is going to come out with their jobs number on Friday. In Canada, we will come out with ours on Thursday because of the holiday. Next week, the Bank of Canada will have their rate hike decision, whether or not they decide to raise rates again. I don't think they will. I think they will remain on pause. And right after that, on the 18th, we'll get Canadian Consumer Price Index. So this is basically the inflation rate for Canada. It's been coming down steadily, in and around 5%. Will we see a number with a 4 on it to start? So these are big dates in the calendar that I think if you're an investor, you want to circle, be mindful of, because on these dates, this data that will be released, whether it's US data, whether it's Canadian data, I think it's going to be very important to the stock market, and it could be market moving. So the government recently, as of August 1st, launched the first home savings account. And in my opinion, I think the government wanted to give individuals something to combat these higher housing prices in Canada, especially in the main urban centers like Toronto, Vancouver, Montreal, etc. So they realized that the first-time home buyers, which now allows you to take up to $35,000 out of your RSP to use towards your first home, just wasn't enough. So they created this first home savings account, which allows individual investors to put in $8,000 per year over 5 years, $40,000 total. And when you buy a home, you'll be able to put that money towards your first home, provided you haven't owned a home, husband and wife, or two individuals that are entering into the agreement to buy the home. Provided you have not owned a home the last 4 years, you'll be able to pull this money out of the first time or the first home savings account tax-free. So it's a great product, actually. It's a kind of a combination between a tax-free savings account and an RSP. It's like an RSP because when you put money into it, you're able to get an RSP deduction for it. Yet when you pull money out of it, like a tax-free savings account, you don't get hit with taxes. So another vehicle that individual investors can use. They can still use their first-time home buyers withdrawal from the RSP, although that money has to be paid back to the RSP over 15 years, whereas first home savings account does not. So that's another difference. But you also have the tax-free savings account that one could use as a down payment towards your first home as well. Tax-free savings accounts, they're really can be used for anything. There is no stipulation as to what you use that for. So really, when you think of it, now there are 3 accounts that the government has created that can be used for purchasing your first home. And hopefully someone that is looking to buy or put a down payment on their first house, hopefully they can build up these accounts, use the first home savings account, the 40,000 there, the 35 from the RSP, and then whatever you can build up in your tax-free savings account towards your first home. And you can do that in a tax efficient way and also get a nice tax deduction in both the RSP and in the first home savings account. And that will help many Canadians across the country save for your first home. So this is the part of the show where I like to take on some questions that I've received from all of you, those that are watching today. And I know the show went a little bit longer. I know we had a bunch of charts and a couple extra topics there. So hopefully I can get to just 1 or 2. First question that we have, this came actually from a viewer, submitted it through Facebook, I believe last show. And his question is actually quite simple. What should we invest in now? And I guess I kind of answered that earlier on in the show. I think depending on how you look at things, if you look at things as the economy as slowing, you want to maybe look at maybe some dividend payers, maybe some individual names that not only can grow, but also pay you a consistent dividend while you wait for the growth. But I also think you want to look at some of the more, or investments in some of the more trendier areas, perhaps artificial intelligence, the cloud, or something that is trending right now. Right now, even oil prices are moving higher. Maybe that's a trend you want to be involved with, some good conservative dividend paying oil companies as a part of a portfolio. So tough to answer what you should be buying now. It also is going to depend on your risk tolerance, your investment objectives, time horizon. So that's a question I'd probably answer on a one-on-one basis. Here's another question which I will take. What do you think is a reasonable return on a portfolio? That a portfolio should have? What kinds of returns do you get for your clients? I get that question asked often, and really it's going to depend on the risk individual investors take. Obviously, higher risk individuals could make more money or lose more. Moderate or medium risk, you're probably looking at over the past year, 8 to 10, 9 to 12% on the top side, maybe -5 to 7 on the negative side. But again, there are no guarantees. Last year, the market was down 20, 22%. The S&P was for individual investors in North America. So some investors lost more than that, even with moderate risk investments. So the kinds of returns I get, or I say for individual investors, is going to depend on them, what kind of portfolios we build, where interest rates are. If you can get 5% on a low risk investment, then medium risk investments should make you significantly more than that. Whereas if interest rates are 1%, 2%, medium risk investments probably would make you more, but maybe not as much as if interest rates are at 5%. So a lot of it kind of depends, and may not be the answer that person is looking for, but that's the reality of it. It's all going to depend on the type of portfolio that I build. So that's all the time we have for this show. I want to thank everyone for tuning in, and I look forward to speaking to all of you in 2 weeks' time. That would be on April the 19th. We're going to have a fantastic guest on the show. Lauren Sugarman will be on the show talking to us about everything metaverse. What is the metaverse? Why are people talking about the metaverse? Can you actually make money from the metaverse or invest in property on the metaverse? We'll get to all these answers and the lowdown on the metaverse in 2 weeks' time. So until then, look forward to seeing you all, and happy investing.